First, what is a breaker block? A breaker block is an area where an opposing side order block fails to hold, gets violated by price, and later becomes a new reaction zone when the market returns to it. From a smart money perspective, this failure is important because it shows that the original side of the market has lost control. For example, if a bullish order block fails and price breaks below it, that tells us the buying pressure inside that zone was not strong enough to continue pushing price higher. As a result, that same area can now become a bearish breaker block because traders who bought from that zone may become trapped. Then, when price returns to it, institutions can use that retest to mitigate losses from previous positions while also entering new positions in the new order flow direction. More importantly, a breaker block acts as a key decision point where the market confirms a shift in control. For a valid bullish breaker block, price must first create a swing low, then a swing high, followed by a lower low. After that, we need to see an immediate bullish expansion move that breaks structure and confirms the shift. In this case, the up-close candle, or series of up-close candles, formed between the first swing low and the swing high, becomes your breaker block zone. That is the area you use to plan your long entry. To enter a trade based on the bullish breaker block, place a buy limit order at the highest point of the block and wait for price to retrace into it. The bearish breaker block is the exact opposite. Price must first create a swing high, then a swing low, followed by a higher high. After that, we need to see a strong bearish displacement move that breaks structure and closes below the swing low, confirming the market structure shift. In that case, the bearish breaker block zone becomes the down close candle, or series of down close candles, formed between the first swing high and the swing low. To take advantage of this setup, you can place a sell limit order at the lowest point of the breaker block and wait for price to retrace into it. Your stop loss can be placed a few pips above the zone. Or, if you want a more conservative approach, you can place your stop loss above the higher high. Breaker blocks are often the main reason why price doesn't return to the extreme order block, formed after tapping into a strong reversal area, or to the fair value gap inside the market structure shift leg, and instead leaves those zones unfilled. In many cases, breaker blocks form slightly above or below reversal order blocks and fair value gaps. Because of that, price is often more likely to react from the breaker block first instead of filling those other key areas. This shows how important breaker blocks are and how much of an edge they can give you when you include high-quality valid ones in your analysis. Now you might ask, what makes breaker blocks more reliable, and why do they often provide safer and better entries? What makes breaker blocks more reliable is that they are not based on a normal reaction from a zone. They are based on a failed zone, and that failure gives us much stronger information about the market. Because when an order block, mitigation block, fair value gap, or inversion fair value gap forms, traders usually expect the price to react from that area. But with a breaker block, price has already shown us that one side of the market has failed. And that is exactly what makes it powerful. A breaker block tells us several important things at the same time. First, the original order block has failed. Second, traders who entered from that order block are now trapped. This tells us the manipulation has already happened, liquidity has already been taken, and price may now be ready to make the real move. Third, the opposite side has taken control of the order flow, and this usually comes together with a market structure shift. Breaker blocks form alongside a change of character or a market structure shift, which confirms that a reversal is likely taking place. On top of that, a change in the state of delivery, CISD, meaning a close above or below the series of bullish or bearish candles that led into the internal or external liquidity sweep, is another reversal pattern that often appears before price creates a breaker block. That adds even more confluence and makes the setup even stronger. This is why breaker blocks can provide safer and cleaner entries compared to many other entry models. So now, let's look at which breaker blocks are higher quality and what features they must have, especially the ones with the highest probability of success. Rule number 1. Higher time frame key area delivery. For a breaker block to be valid and tradable, first and foremost, Price must originate from a higher time frame area of interest, such as a higher time frame fair value gap, a supply or demand zone, or after sweeping liquidity from a major swing high or swing low. You cannot take every breaker block that appears randomly in the middle of nowhere. Context is everything. Without higher time frame delivery, breaker blocks can easily act as inducement zones or form during temporary retracements that trap you in seconds. Rule number 2. Breaker blocks created with inefficiency. A breaker block becomes much stronger when it overlaps with a fair value gap and is formed with clear inefficiency. When that happens, price is more likely to react from the breaker block first, which increases the probability of the setup. That overlap makes the breaker block zone much stronger and more reliable, and it is often the reason why price continues its move without returning to the extreme order block or filling the fair value gap.